Welcome back to the Deep Dive. Today we're diving into the sometimes murky, but always fascinating world of HMDA reporting.
Yeah, murky is a good word. It's definitely an area where you need to roll up your sleeves and get into the details.
For sure, and to help us navigate those details, we've got excerpts from a guide to HMDA reporting, Getting It Right for 2024.
Always a good starting point. That guide is packed with insights.
Absolutely. And for our listeners who might not be familiar, HMDA stands for the Home Mortgage Disclosure Act.
Yeah, it's all about lifting the curtain on the mortgage market, seeing who's getting loans, who's not, and what the terms look like.
Right. It's about transparency and accountability in lending. So let's jump right in. Who actually needs to report under HMDA?
Well, not every financial institution has to report, just certain ones.
Makes sense.
For your typical banks and credit unions, what we call depository institutions, there's a few tests they need to pass.
Okay, lay it on us. What are those tests?
First up, we've got the asset size threshold. Basically, the institution's assets on the preceding December 31st have to be over a certain amount.
Oh, so it's like a minimum size requirement.
It is. And here's the thing. That threshold changes every year.
It does.
Yeah, it's based on inflation and other economic factors. So you've got to check the latest figures each year to know if you need to report.
So even if you were in the clear last year, this year could be a different story. I see.
Exactly. Moving target. Then we've got the location test. To be covered, the institution needs to have a physical office in a metropolitan statistical area, or MSA.
Ah, those densely populated areas, like cities and their suburbs.
You got it. Think New York City, Los Angeles, Chicago, those kinds of places.
So a small credit union out in a rural area might not have to report.
Probably not. But a big bank with branches across the country, that's a different story.
Makes sense.
The last test for depository institutions is the loan activity test. Did the institution originate at least one home purchase loan or a refi of a home purchase loan in the past year?
Okay, so they actually have to be making these kinds of loans, not just holding assets or having branches in the right places.
Exactly. And we're talking first linen loans, those 1 to 4 unit dwellings,
Yeah.
your typical houses or smaller apartment buildings.
Got it. So it really is about institutions actively engaged in the residential mortgage market.
Right. Now, for your non-depository institutions, your mortgage lenders that aren't also banks, things are a little different.
Okay, how so?
They still need to meet that location test, being in an MSA,
Okay.
but instead of looking at a single loan, their loan activity test is based on volume.
Interesting. So a numbers game for them.
Yeah. They need to have originated at least 25 closed-end mortgage loans or 200 open-end lines of credit during the preceding year.
So there are different thresholds depending on the type of institution.
There are, and those thresholds actually changed in recent years, so it's more important than ever to stay up to date.
Good point. Now, are there any exceptions to these rules? Like, are there institutions that might slip through the cracks?
There are some exemptions based on state law, and there are some special rules for mergers and acquisitions. But for the most part, yeah, HMDA is about casting a wide net to get a really comprehensive picture of what's happening in the lending market.
Okay, so we've got a good handle on who needs to report. But what about the loans themselves? What transactions are we actually talking about here?
Not every loan an institution makes is going to be reported under HMDA.
Okay, that makes sense.
They're looking for specifically covered loans and applications, and those are defined very precisely in the guide.
I'm sensing a theme here. Lots of very specific definitions in the world of HMDA.
Oh, definitely. Precision is key. So let's break down what kinds of loans we're looking at.
All right, fire away. What are the key criteria for a loan to be a covered loan under HMDA?
Well, the main thing is that the loan has to be secured by a dwelling.
Okay, so like a mortgage on a house.
Yeah, that's the classic example. But remember, dwelling has a very specific meaning under HMDA.
Oh, I bet. Wouldn't be HMDA without a very specific definition. So what does dwelling actually encompass?
Well, you've got your typical single-family homes, apartments, of course, but it also covers multifamily dwellings, even manufactured home communities.
Really? So it's broader than I might have initially thought.
Yeah, it is. And the key is whether the primary use of the property is residential.
So a building that's mostly apartments, that would count, even if it has like a little retail space on the ground floor or something.
You got it. The guide even has some really interesting examples about this. Like, what about a property that's used for both long-term housing and assisted living? It really gets you thinking about the edge cases.
That is interesting. It sounds like you really need to break down each transaction and see if it fits the HMDA definition of dwelling.
You absolutely do. It's all in the details.
Okay, So we've got those dwelling secured loans. What other types of loans are we talking about?
Well, you've got your home purchase loans, refinancings, home improvement loans, and your open-end lines of credit.
So like HLOCs, those home equity lines of credit.
Exactly. Those are all in.
All right. Now, I'm guessing there are also loans that are specifically excluded from HMDA reporting, even if they might seem like they'd fit the criteria.
Oh, you bet there are. Just as important as knowing what's in is knowing what's out. What we call excluded transactions.
Okay, so what are some of the loans that don't make the cut?
For instance, loans for temporary financing are excluded.
So like a bridge loan.
Exactly. Bridge loans, construction loans, anything short-term.
Interesting. So it's really about those more permanent financing arrangements.
It is. Then you've got loans secured by vacant land, so we're talking about buying an existing house, not building a new one.
Okay. And I'm guessing loans for commercial properties are also out.
Well, here's where it gets a little tricky. Loans made primarily for business or commercial purposes are usually excluded,
Okay.
unless they're specifically for home improvement or a home purchase or a refi, so there's some overlap there.
Ah, so even if a loan is for a business, it might still need to be reported if it's tied to a dwelling in a very specific way.
You nailed it. It all comes down to the purpose of the loan and how it relates to that dwelling.
Okay, so we've got our players, the institutions, and we know the game, the covered loans. Now, let's talk about the scoreboard, the data itself. What kind of information needs to be reported?
This is where it gets really granular. HMDA requires a lot of data points.
Oh, I bet. I'm ready to get into the nitty-gritty. What are some of the key data points that HMDA wants to know about?
Well, it starts with applicant information. Age, race, ethnicity, sex, income.
Okay, the demographics of the borrower?
Exactly. But here's the thing. The guide is really specific about how this information is collected.
It is.
Especially for race and ethnicity. It's not just a simple checkbox anymore.
So what's changed?
Well, applicants can now select multiple subcategories within those broader categories. Like, within Asian, there are several subcategories you can choose from.
So someone who identifies as both Hispanic and Asian could choose both subcategories instead of being forced to pick just one.
Exactly. It recognizes that people don't always fit neatly into those big buckets.
It's really important, getting that level of detail right from the start.
It is. Okay, moving on, we've got loan characteristics. The amount, the rate, the term, even what kind of purchaser is involved. Is the loan going to Fannie Mae or Freddie Mac?
Wow, so it goes pretty deep.
Then there's credit score information. And it's more than just the number.
Oh, how so?
HMDA wants to know the specific scoring model used.
The scoring model.
Yeah, like was it FICO, Vantage Score, or something else entirely?
I wouldn't have thought of that.
It's important, though, because different models weigh factors differently, and that impacts the scores.
So my creditworthiness could literally look different depending on which model a lender is using.
It really could, and that's why HMDA wants that granular level of detail.
It makes sense. They're really trying to understand the whole context of these loans.
They are. And get this, they even want to know about the automated underwriting systems used, like which specific system was used and what result it came up with.
Wow. So they're really trying to get a sense of how these lending decisions are being made, even the automated parts.
Exactly. Data-driven decision-making at its finest.
It's fascinating, really. But we haven't even talked about debt-to-income ratio and combined loan-to-value ratio yet.
No, those are big ones, and HMDA is super precise about how those are calculated.
Super precise.
Yeah, like down to the decimal point precise.
Wow, that seems like a lot of pressure to get those calculations exactly right.
It is. But there's a good reason for it. Even small variations in those ratios can paint a different picture of risk.
So it's about making sure everyone's on the same page when it comes to assessing those financial metrics.
It is. Consistency is key when you're talking about data analysis on this scale.
It sounds like we've just scratched the surface of all the data points HMDA wants to know about.
Oh, we definitely have. We haven't even talked about prepayment penalties or the type of property being financed.
Well, it's clear that HMDA leaves no stone unturned when it comes to gathering information about these loans. But let's shift gears for a moment and talk about the reporting process itself.
Sure, let's dive into that.
So we've gathered all this data. What happens next?
Well, first things first, institutions have to record all this data within 30 calendar days after the end of each quarter.
Oh, so it's not like they wait till the end of the year and try to remember everything.
Not at all. It's ongoing.
Okay, so they're keeping a running tally. What happens after that?
Then comes the actual reporting. Everyone submits an annual report by March 1st of the following year. No exceptions.
Okay, so there's that one big deadline everyone has to hit.
Right. But for your high-volume lenders, those who originated at least 60,000 covered loans and applications, they've got quarterly deadlines too.
Oh, wow. So they're reporting much more frequently.
Yeah, it's a constant cycle for them.
I can imagine. And on top of those reports, institutions also have to disclose their HMDA data publicly, right?
They do. That includes posting notices in their branches and making the data available online.
So there's a real transparency element here. People can actually see what's happening in their local lending market.
Exactly. It's all about making that information accessible.
I have to ask, though, what happens if an institution doesn't follow all these rules? Are there consequences?
Oh, there are definitely consequences. HMDA violations can lead to some pretty hefty penalties.
Like what? Give us an idea of the stakes here.
Well, we're talking about fines that can be pretty substantial, regulatory sanctions that can limit an institution's ability to do business.
So it's not just a slap on the wrist.
Not at all. It can even lead to legal action, which obviously gets expensive and time-consuming.
Wow, so the stakes are pretty high.
They are. And beyond the financial hit, there's reputational damage to consider too. Consumers are paying more attention to how institutions operate these days, and a HMDA violation, that can really erode trust.
It's not just about ticking boxes and avoiding fines. It's about upholding a certain standard of accountability and transparency.
Exactly. And it all comes back to the data itself. What happens when that data isn't accurate or complete? What are the implications there?
That's a great question. We've talked about the importance of accurate data, but I'd love to explore that further. What are the risks of flawed or incomplete data when it comes to HMDA?
It's a crucial question because remember, this data isn't just for compliance. It's a valuable tool for everyone. Researchers, policymakers, community organizations, anyone who wants to understand lending patterns and identify potential issues.
So if the data is flawed, those insights are flawed too.
Exactly. Imagine you're a researcher trying to study lending disparities in a particular city, but the HMDA data for that area is riddled with errors or missing information.
Well, your whole analysis would be skewed.
It would. You could end up with inaccurate conclusions and ineffective solutions.
Makes sense. Garbage in, garbage out.
That's the saying. Or imagine policymakers are trying to design programs to promote affordable housing, but they're relying on HMDA data that doesn't reflect the real needs of the community.
Those programs could miss the mark completely.
Exactly. So the integrity of the data, it's paramount. It's not just about numbers on a spreadsheet. It's about real-world impact.
That's such a powerful point. Okay, so we've seen how HMDA reporting can go wrong, but let's end on a positive note. What can we do with this data when it's done right? What's the potential here?
Now that is the exciting part. The power of HMDA data to drive positive change is huge, but we're going to have to save that conversation for part 2 of our deep dive. So stay tuned.
I'm definitely intrigued.
Well,
Until next time, happy deep diving. Welcome back to the deep dive. Last time, we got pretty deep into the weeds of HMDA reporting.
we did. Lots of details, lots of definitions, but all important stuff.
It is, and it laid a really solid foundation for where we're headed today.
Exactly. Today's all about putting that knowledge to work.
Right. It's time to talk about what we can actually do with all this HMDA data.
The why behind the what, you could
Yes,
say.
exactly. So let's revisit those data points we talked about. HMDA wants all this detailed information about the applicant, things like age, race, ethnicity, sex, and income.
Right. And remember how we talked about how specific HMDA is about how that information is collected?
I do, especially for race and ethnicity.
Yeah. That's not just about the data itself, it's about understanding the context in which it was collected. Really important.
You mentioned how institutions have to report whether they got that race and ethnicity data from the applicant directly or if they had to rely on visual observation or a surname. Why is that distinction so important? It seems like that would be kind of burdensome to track, honestly.
It might seem like a small detail, but it actually speaks to a larger issue of data integrity and potential bias.
Okay. I'm listening.
Imagine a scenario where an applicant self-identifies as one race on the form, but the loan officer, maybe based on their name or something, categorizes them differently.
I see what you mean.
That discrepancy, that could reveal unconscious bias or even potentially more troubling biases. So it's definitely something to pay attention to.
It adds another layer of scrutiny to make sure the data is as accurate and unbiased as possible.
Right. And think about it from your perspective. If you were looking at HMDA data to understand lending patterns in your community, wouldn't you want to know that the data is reliable? that it actually reflects the true demographics of the borrowers.
Absolutely. It makes a huge difference in how we interpret the data.
It does. Okay, let's talk about those more complex financial data points like debt-to-income ratio and combined loan-to-value ratio.
Ah, yes. The ones where HMDA wants them reported with incredible precision, down to the decimal point, it seemed.
They do. And it's not about being nitpicky. It's because those ratios, they're key indicators of a borrower's financial health, their ability to repay a loan.
Okay, I could see how that would matter.
Even a small variation in how those ratios are calculated, it could paint a very different picture of risk. And ultimately, that could influence lending decisions.
So it's about making sure we're all using the same yardsticks, so to speak.
Exactly. Consistency is crucial when you're comparing apples to apples.
Makes sense. And I remember how you mentioned that institutions have to specify the exact version of the credit scoring model they used.
Oh yeah, that's another one where the details really matter.
At first, I thought it seemed like splitting hairs. But then you explained how different versions of FICO, for example, can weigh factors differently, and that can impact scores.
Right. Your creditworthiness could look different depending on which model a lender is using.
It's crazy to think about. But it makes sense why HMDA would want that level of granularity.
It's all about creating a level playing field for data analysis.
Okay, I'm convinced. The devil is in the details.
He is. All right, let's move on to the reporting process itself. We know institutions have 30 days after the end of each quarter to record all this data.
That's right, keeping that running tally.
But then what? How does that data actually get submitted to the powers that be?
Yeah, what's the next step in the journey?
Well, there are different deadlines depending on how many loans an institution originates. Every institution has to submit an annual report by March 1st of the following year.
No exceptions.
Nope, that one's a hard deadline. But if an institution reported at least 60,000 loans and applications the year before, they've got to file quarterly reports too.
Wow. So for those high-volume lenders, it's really a constant cycle of data gathering and reporting.
It is. And here's an interesting thing. If a financial institution changes its reporting agency during the year, maybe because of a merger or a change in charter,
Okay.
they have to indicate that change in their reports.
In both the annual and quarterly reports.
Yeah, both. It's all about transparency.
It's like keeping a chain of custody for the data,
Yeah,
making sure everyone knows where it's been and where it's going.
you got it. And even though most institutions submit their reports electronically these days, they're still required to keep a copy of their data for at least 3 years.
Like a backup.
Exactly. Just in case there are questions down the line, you never know.
It's like keeping your receipts after you file your taxes, just in case the IRS comes knocking.
That's a good analogy. Okay, now let's talk about consequences. We touched on this last time, but I want to emphasize just how seriously HMDA violations are taken. We're not talking about a slap on the wrist here.
Right, this isn't a parking ticket.
Not at all. We're talking about potential fines that can be pretty substantial, regulatory sanctions that can really limit an institution's ability to operate, and even legal action, which is obviously costly and time-consuming.
So those stakes are pretty high.
They are, and it goes beyond just the financial hit. There's reputational damage to consider, too. Consumers are more informed and empowered than ever, and they're paying attention to how institutions are behaving. A HMDA violation, that can signal a lack of transparency, a lack of accountability, and that can really erode trust.
It's a big deal.
Right.
So it's not just about protecting institutions from penalties. What happens when the data itself isn't accurate or complete? What are the implications there?
That's a crucial point. Because this data, it's used for so much more than just compliance. It's a valuable tool for researchers, policymakers, community organizations, anyone who wants to understand lending patterns and identify potential issues.
So if the data is flawed, those insights are flawed too.
Right. Imagine researchers are trying to study lending disparities in a certain city, but the HMDA data for that area, it's riddled with errors or missing information.
Their analysis would be incomplete.
It would, potentially leading to inaccurate conclusions and ineffective solutions.
It's like building a house on a shaky foundation. It's just not going to hold up.
Exactly. Or imagine policymakers are trying to design programs to promote affordable housing, but they're relying on HMDA data that doesn't accurately reflect the needs of the community.
Those programs might miss the mark completely.
Exactly. So the integrity of the data, it's paramount. It's not just about numbers on a spreadsheet, it's about real-world impact.
Powerful stuff. Okay, so we've seen how HMDA reporting can go wrong. But let's end on a positive note. What can we do with this data when it's done right? What's the potential here?
That is the exciting part. The power of HMDA data to drive positive change is huge. But we're going to have to delve into that in the final part of our deep dive. Stay tuned.
Can't wait. Until next time, happy deep diving.
Welcome back to the deep dive. We've been on quite a journey these last two parts, haven't we?
Yeah, we've really dug into the nitty-gritty of HMDA reporting, all those details and definitions.
And it's been fascinating, hasn't it?
Absolutely. I mean, who knew there was so much to know about just reporting on mortgage data?
Right, but it's all been leading up to this, the big reveal, so to speak.
Exactly. It's time to talk about what this data can actually do.
Right. We've got these mountains of data, but what are the stories these numbers are telling us?
That's the exciting part. How can we use this information to understand the lending landscape and maybe even make a difference, in our communities? Okay, paint the picture for us. What kind of insights can we actually get from all this HMDA data?
Well, for starters, we can start to see patterns, like trends emerging. We can see which lenders are most active in a particular area, what types of loans they're making, what the terms look like.
So we can start to get a feel for the overall health of the lending market in different areas.
Yeah, we can. And we can also look at things like denial rates and interest rates.
To see if certain groups of borrowers are being treated differently.
Right, to see if there are any disparities in lending patterns.
Like, are certain groups being denied loans at higher rates than others, even if they have similar credit profiles?
Exactly. Or are they being offered loans with higher interest rates, less favorable terms, things like that.
So we can use this data to identify potential red flags for discrimination, even if it's unintentional.
You got it. It's about shining a light on those systemic issues that might otherwise slip through the cracks.
That's powerful. It's not just about crunching numbers, is it? It's about using data to understand the human impact of these lending practices.
And it goes beyond just identifying the problems. HMDA data, it can help us actually craft solutions. Oh.
How so?
Well, think about it. Policymakers, they can use this data to design programs, right? And policies to promote fair and equitable lending.
So they can use the data to actually make things better.
Exactly. They can target resources to areas that need them most, or create incentives for lenders to serve underserved communities.
It's not just about pointing fingers. It's about using this data as a roadmap.
A roadmap for positive change, yeah.
That's a great way to put it. Now, I've heard that community organizations are also using HMD data to advocate for better lending practices in their neighborhoods. Is that right?
Absolutely. They can use the data to hold lenders accountable, to identify areas where access to credit is limited, to push for more investment in those communities.
So it's about empowering people with information so they can be active participants in shaping their communities.
Exactly. Knowledge is power, right? And when communities have access to this kind of data, they can really make a difference.
Makes sense. And I'm guessing researchers are also using HMDA data to study all sorts of things about the mortgage market.
Oh, absolutely. They're using it to understand trends, develop new models for assessing risk, all kinds of things.
It's a gold mine of information.
It is. And here's the best part. HMDA data, it's publicly available.
It is. So anyone can access it.
Anyone. You can go online, see how lenders in your neighborhood are performing, what types of loans they're making, what their denial rates look like. You can even compare different lenders side by side.
So I can actually do my own research and see what's happening in my community.
You can. And you can even use that data to advocate for change. If you see a pattern of discriminatory lending, you can bring that to the attention of local officials or community organizations.
It's about turning data into action.
That's exactly what it's about.
This has been eye-opening, really. We've seen how this whole complex process of HMDA reporting yields this incredibly valuable data that can be used for so many things.
It's amazing, isn't it? How those numbers can actually help us create a fairer and more equitable system.
It is. Well, I think we've covered just about everything there is to cover on HMDA reporting.
I think we have.
Any parting words of wisdom for our listeners before we wrap up this deep dive?
Just this. Remember, data is only as powerful as our ability to understand it and use it. So keep learning, keep exploring, keep asking questions.
Beautifully said. Until next time, happy deep diving.